This content is for educational purposes only and is not financial advice. Investing involves risk. Do your own research and consult a professional before investing. Hey everyone, welcome back to the channel. For those of you focused on Canadian income investing, when you're looking into high-yield ETFs from providers like Hamilton or Evolve, you often run into two major blind spots that can be a real headache. First, what is the actual performance when you factor in dividend reinvestment? Many websites only show you the price action, completely ignoring the compounding power of that over 10% yield in a rolling backtest. Second is the issue of missing data. A lot of popular ETFs aren't listed on the TSX. They're on CBOE Canada, formerly the NEO exchange. Because of this, standard analysis tools flat out fail to pull the data. To solve these pain points for the community, I've taken some time recently to build a fully automated ETF comparison tool. It makes it super easy to calculate total returns with dividends reinvested, and you can compare multiple funds side by side all at once. Most importantly, it's fully compatible with both the TSX and CBOE Canada. The price data is pulled from Yahoo Finance, and the dividend data comes from dividendhistory.org. I've dropped the link in the description below. It's completely free to use. So in today's video, let's dive right in and use this new tool to do a deep dive comparison of a few funds I've been meaning to review and see how they actually stack up. When you look at this chart, you might notice that the starting point of the backtest isn't random. I added a bit of logic here. When you input multiple tickers to compare, if there's less than a year of data, the tool automatically identifies the newest fund in the group and sets its inception date as the starting point. For instance, in this example, because CDAY was just launched on July 15, 2025, it has the shortest track record. So, the system automatically aligns the start of the backtest to that specific date. Looking at the results with DRIP factored in, both of these highly discussed funds in the dividend community have performed remarkably well. As of February 19, 2026, the total return of HDIV hit 27.32%, with CDAY following closely behind at 25.25%. Let's take a look at the red and green lines on the chart. HDIV generally maintained its lead throughout this period, while CDAY clearly gained a lot of momentum later on. Ultimately, both outperformed our benchmark XIU, which returned 22.83% over the same time frame. So overall, if we're looking strictly at total return, HDIV does have the edge over CDAY. However, at this point, I want to share my actual real-life moves. Since the beginning of this year, I've had a feeling that my job situation might become a bit unstable, and I might even be facing some layoff risks. So, to maximize my cash flow, I recently swapped out all my HDIV for CDAY. There are three main reasons behind this move. First, of course, is to maximize my monthly cash flow to build a buffer for a rainy day. Second, it's for defensive purposes. Right now, QDAY and QQQY make up nearly half of my portfolio, so I desperately needed some defensive ETFs to cushion any downside. And since the underlying asset of CDAY is CMVP, which is packed with high-quality companies that consistently grow their dividends, its defensive profile is excellent. Finally, my personal investing style leans more towards index-based products. Taking everything into consideration, for my current financial situation, CDAY is just a better fit than HDIV. But I have to emphasize, this does not mean CDAY is fundamentally a better fund than HDIV. In my opinion, the target yield of HDIV range of 10% to 12% is much more sustainable in the long run. By contrast, CDAY's massive 18% yield feels a bit too aggressive. Keep in mind its underlying ETF CMVP only averages an annualized return of around 10%. While CDAY has indeed outperformed CMVP, capping that yield at around 15% would probably be more reasonable and healthy. The fact that an 18% yield hasn't caused issues yet might just be because we're in a raging bull market. Whether or not that payout is truly sustainable in the future is something we'll need more time to observe. Now that we've looked at the Canadian market, let's move on to another highly requested matchup. The US market high dividend heavyweights, HYLD and SDAY. To give us a clear point of reference, I've thrown in VSP, the CAD hedged S&P 500 ETF, as our market benchmark. Looking at the latest data pulled from the tool, with DRIP included, SDAY hit a total return of 16.48%, successfully overtaking HYLD at 11.6%. Meanwhile, our benchmark, the VSP, came in at 9.39% for the same period. If you look closely at the price action on this chart, it's pretty fascinating. For a long time, HYLD was absolutely dominating SDAY, with its returns leading by a wide margin. However, pay attention to the far right side of the chart, specifically around early February of this year. Both the HYLD and the VSP suffered a significant drawdown. The reason behind this is pretty clear. the tech sector recently went through a fairly brutal valuation pullback. Meanwhile, the green line representing SDAY showed incredible resilience during this phase. Not only did it barely drop, but it kept grinding steadily upward, ultimately taking the lead. The reason it's so stable is because the underlying asset of SDAY SMVP is packed with traditional value stocks. It's completely decoupled from the wildly volatile AI hype we've seen lately. Its logic is very similar to CMVP, which we discussed earlier, giving it fantastic defensive qualities in our current market environment. This is the core reason why I bought into SDAY. Of course, I didn't go crazy and go all in on it, but within my portfolio structure, it plays a vital defensive role. Now that we've covered value ETFs for portfolio defense, let's finish up with a hardcore comparison in the tech sector. This time, I've grouped BIGY, HHIS, QDAY, and QQQY all together, and I threw in QQC, which tracks the Nasdaq 100 as our market benchmark. Let's look straight at the results. As of February 19, 2026, with DRIP included, QQQY has a total return of 5.01%, QQC is at 2.76%, and QDAY is at 2.01%. In contrast, the two funds at the bottom are still sitting in deep negative territory. HHIS is at -9.53%, and BIGY is down at -10.79%. Focus on the far right of the chart, the price action from late January into early February. It's glaringly obvious. During this recent tech sector valuation correction, all these ETFs, along with the broader market, took a massive dive. And looking at the very tail end of the chart, the current trend is still heading downward. We haven't fully bottomed out yet. Even though QDAY and QQQY are still showing positive total returns in this backtest and keeping pace with the market, it's really nothing to brag about. You can clearly see from the curve that when the Nasdaq dumps, these funds tank right along with it. That downside volatility hurts just as much. This is the true nature of high-yield tech ETFs. Strong offensive capabilities, but they absolutely don't hold back during a pullback. I also want to offer some encouragement to those of you holding tech ETFs right now. Opening your brokerage account recently and seeing your profitable positions shrink drastically is definitely a tough pill to swallow. But when you invest in high volatility sectors like this, massive swings up and down are just part of the game. As long as the underlying thesis for the top-tier tech companies in the Nasdaq hasn't fundamentally changed, there's no need to panic over a short-term downtrend. This is exactly why I kept emphasizing defense in the first half of the video. In an uncertain market environment like we have today, you absolutely need to build a solid foundation with robust products like CDAY or SDAY or other defensive positions. With continuous cash flow from your defensive holdings acting as a safety net, you can maintain a steady mindset when facing these brutal tech sector drawdowns, preventing you from panic selling at the absolute bottom. Proper asset allocation, viewing short-term pullbacks objectively, and patiently letting your dividends snowball, that is the best way for us everyday retail investors to handle headwinds. This video mostly just covers my own portfolio, so it might feel a bit unpolished. Huge apologies for that, but all my time has been tied up building this tool. Since the data is pulled via web scrapers, if you run into any issues, please reach out so I can update it. Since my YouTube channel isn't monetized yet, please bear with me embedding my videos on the site. I personally feel this is much more restrained than trying to sell you personal coaching or premium spreadsheets. I'll be maintaining this site continuously as a personal side project. If you spot any bugs while using it, or if there are new features you'd like to see added, let me know in the comments below and I'll keep rolling out updates. Thanks for watching, guys. I'm Oldfish. If you found this content helpful, please hit that like button, leave a comment, and subscribe. Catch you in the next one.